Very nice job of it.
Yeah. Thank you all very much for joining us this morning. My name is Steve McMenamin. I'm the Executive Director of this group, and I'm your host for today's event, which is part of the ongoing series of the Greenwich Roundtable. It gives me great pleasure to welcome back Sue Carter and the Common Fund Institute, who've generously sponsored our symposium today. Our topic is India, Bengal Tiger or Bureaucratic Elephant. This is a continuation of our series on the emerging markets. Our speakers today are the ideal panelists, our dream team, our formula, which we have one knowledgeable expert, a hedge fund manager, and a private equity manager. Our moderator is Ryan Dartnell. Ryan is the Chief Investment Officer of Granite Associates, a New York-based family office. Ryan is also a trustee and a member of our programming committee. And before we get started today, I would like to mention the art on the walls you see around us. You know, we have these changing exhibitions. A couple of things I'm very proud of is that our members, John Loeb, has recently come off a very dazzling exhibition in the main gallery of Danish art. But the art you see around the walls are just a very, very, very small piece of the collection from Dave and Reba Williams, and we're very grateful to them for lending it to us. And so with that, I'd like to thank you. And Brian?
Thank you, Steve. I'm very happy to be here for our fourth session on emerging markets. We had a similarly packed room for China, for Russia, and in May we had Latin America with Presidents Zedillo and Peter Gruber. I'm confident that this group today will be at least as strong as those groups. I think our timing on having this India session is really excellent. Manmohan Singh, the Prime Minister, was in Washington this week addressing the joint houses of Congress. I gather that Ambassador Wisner was there, so I think the perspective from his side will be very fresh, and similarly our other two panelists have just flown in from India. So I'm extremely happy to welcome them today, and I'm going to spend a couple of minutes on their backgrounds to introduce them. Ambassador Wisner is a native of New York and a Princeton grad. He's currently the Vice Chairman, External Affairs at AIG. Most of his career he's been a senior diplomat. He currently holds the personal rank of Career Ambassador. From 1994 to 1997, he was ambassador to India. Prior to that, he was ambassador to the Philippines. Before that, ambassador to Egypt. And before that, ambassador to Zambia. So a very prominent role in some very interesting places. He served in a number of positions in the U.S. government, including Undersecretary of Defense for Policy, Undersecretary of State for International Security Affairs, Senior Deputy Assistant Secretary for African Affairs, and Deputy Executive Secretary of the Department of State way back in 1977. Thank you for coming. Ashish Dhawan is co-founder of Chris Capital. Chris Capital is a private equity firm based in New Delhi, India. He previously worked at Goldman Sachs in the proprietary investment group, and prior to his experience at Goldman, had a variety of interesting private equity and merger and acquisition jobs at Garantia Partners in Brazil, McCown DeLu, and Wasserstein Perella. He has a very sparkling academic record with distinction from Harvard, where he did his MBA, and he did a dual degree at Yale for his undergraduate education. He lives in India. Samir Arora, to his left, is the founder and fund manager of a new firm called Helios Strategic that is based in Singapore. He has extensive fund management experience in India. He spearheaded Alliance Capital's efforts in India and has a continuous track record of over 10 years. Most recently, he was the Chief Investment Officer for India as well as for all of Asian emerging markets based in Singapore. He left in 2003 and has recently started this firm, as I mentioned. He also has a stellar academic background. He went to the Indian Institute of Technology for his undergraduate degree in engineering. He then did his master's in finance in India, and to prove that he really likes finance, he did his master's in finance at Wharton. So I think we'll have a very educated group here this morning. And as Steve's mentioned, I think it's a nice balance between the different speakers. Just before I hand over, I thought I'd spend a couple of minutes on a little bit of historical background, as I think I've done in each of these sessions. Just over 400 years ago, in 1599, the British East India Company was founded. The Dutch traders had recently raised the price of pepper, and the British wanted to compete. There was an era of colonialism and conquest. Queen Elizabeth I was backing all of this, and under her royal charter, the British East India Company started. By 1600, the ships were back and forth between India and Britain, and I think that started the conquest, or the, let's call it, strong influence that India had from Britain for the last 400 years. In 1858, the East India Company was terminated, and responsibility to rule 300 million Indians at that stage handed over to a young Queen Victoria. At the age of 39, she was now in charge. In Rudyard Kipling's words, responsibility for ruling India had been placed by the inscrutable design of Providence upon the shoulders of the British race. And at that stage, effectively, the British Raj was formally in place. About 100 years later, 1947, Mahatma Gandhi was raising Cain and doing his nonviolent insurrection, if you will. World War II had taken place, and the British were severely weakened. Labour Prime Minister Attlee appointed Louis Mountbatten, George VI's cousin, to be the 20th Viceroy and the final Viceroy of India, under orders which he was worried about to sever ties or withdraw from Britain. At the same time, I think we'll all remember, or at least have read, about the partitioning of India and the birth of Pakistan. So that unleashed what it turned out to be the largest human migration in the history of man. And Ashish was talking last night at dinner about the fact that several of his family members lived in the then Indian Lahore and had to move to India. In the early 1960s, moving along, John Kenneth Galbraith was President Kennedy's ambassador to India, and he described India as a functioning anarchy. Nehru was India's first prime minister, and he was busy trying to chart a course between democracy in the United States and the ideals of socialism in the USSR on the other hand. The result was 5-year plans, central planning, bureaucracy, some level of corruption, and some level of inefficiency. India's development model was, I think, perhaps too focused on mega projects, steel mills, large factories, and not as focused on appropriate technology and the use of abundant labor. For the past 50 years, I'd say the question in India was not so much when would India emerge as when would India finally collapse. And I think in 1990 we saw probably the bottom of that with the collapse of the Soviet Union and the withdrawal of support. You had incredible pain in India. Consider that reserves were probably less than $1 billion. Import cover was less than 1 month. And contrast that with today, you have about $150 billion, a stable currency, low inflation. And then lastly, we've had 10 years of growth of 5 to 6%, and in the first quarter we've had 7% growth. So very strong reform. I think it's very significant that while Ambassador Wisner was there, Manmohan Singh was the finance minister, and he was probably the most responsible for the liberalization program that's helped so much in India. So without any further distraction from me, I'm very happy to hand over to Ambassador Wisner.
I borrow your... Mr. Dart, well, thank you very much for that introduction, and particularly for setting the stage as you've just done, covering the historical sweep of hundreds of years in a mere 3 or 4 minutes. I also am grateful to all of you for letting me come and be part of this morning. It's an exciting occasion. Mr. Trahan, you in particular, for having talked to me about it, and then it's an honor as well to appear with Ashish and Samir on the same podium, two very accomplished players in financial markets, two fine businessmen. I have looked back on this week and tried to give it some perspective. It's very hard in the lives of two nations, particularly two great nations with complicated and long histories, to pick moments that you could identify as turning points in their relationships. But I'd like to think that July 18 will go down as one of those major defining moments in the lives of two very important powers, one established, the United States, one emerging, India. The India that arrived in Washington on Monday, the Prime Minister, his entourage, meetings with the President, the joint session of Congress, the dinners in the State Department, at the White House, were all symbolic ways of addressing the fact that the United States has come to view India, and India has come to view the United States through very different lenses in a remarkably short period of time. To all of us, the most striking feature, as Mr. Darwell has just pointed out, is the remarkable growth of the Indian economy, an economy that today is achieving about 7% growth in gross domestic product and shows every reasonable promise of an average of that for the years ahead. Set in a setting of declining inflation, the numbers are down to about 5.5%, the highest foreign exchange reserves in India's history. You reminded us of the early 90s when there were only a couple of months of import coverage. Today, with $150 billion in the bank, India has never been so comfortably situated. And the growth that we are seeing in India today is broad-based. It's not just in the well-known service market that has great export potential, but Indian manufacturing has been enormously successful and worldwide competitive. Agriculture, given the fact that the overwhelming majority of Indian agriculture is rain-fed, remains volatile. And the capital markets have perked up. Interest rates are lower. When I left India, they were in the middle teens. Today, they are down to about 6%. What we've seen behind these figures is a steady but occasionally uneven retreat of government from the commanding heights of the economy and the assertion of the Indian private sector. India is, in my judgment, on the road to an open economy, and that page will never be turned back. The growth that India is experiencing today is driven principally by domestic consumption. The huge untapped Indian market will continue in the years ahead to power Indian economic growth. And with this, a credit boom, rising incomes, a growing service sector, positive demographics, now that India can care for her people with 54% of the population under 25 and the highest levels of literacy in history, India promises to be a market in which population is less a detriment than an attribute. Capital expenditure by business, infrastructure spending by government are all up and will continue to be so in years ahead. And while I signal and underscore the importance of the domestic market, foreign trade is a powerful sector of the Indian economy, expanding over an average of recent years at about 20% per annum. Vibrant, moving, an economy that is growing and, in my judgment, will continue to grow. But the primary reason that India's economy will grow is that it has ceased to be an economy that is dependent on the decisions of government, but rather it's an economy today that is powered, fueled, and led by the Indian private sector. I am, therefore, before you today as an India optimist, but I'm also quite capable of recognizing that India could do much more, and in fact, some aspects of India's performance are worth your attention as investors and will tend to drag India back. I'd like to think that India could be an 8 to 9% have an 8 to 9% growth rate, but will not. Will not for many reasons. First of all, and while we as Americans can hardly have much to say or even brag about, the fiscal deficit in India is a big problem for the nation over the longer period of time. A rising public debt matched by deteriorating finances in the Indian states, off-budget finances, a declining savings rate, all add up to a troubling fiscal picture, one that, given the politics of India, government finds difficult to deal with. For those of you who go to India for the first time, you'll be struck by other aspects that drag India's performance. A very, very large public sector with a very large public sector workforce, either in government or in state enterprises, a low tax take, therefore, unfortunately, less than necessary level of government investment, particularly in infrastructure, hard and soft, in electricity, transportation, health, and education. You'll also be struck by the complexities of Indian governance, the complex known to us in this country of issues posed by center-state relations. India, like the United States, though the dynamics are different, being a federal union. But when you look at center-state relations, you immediately come into strikingly difficult economic problems, resolution of, for example, issues in the electrical power sector, the inability of states to keep their obligations in Orissa, in Tamil Nadu, until really only several weeks ago in Maharashtra, limiting the possibility for foreigners to invest in electricity and give India the power that she needs. That center-state dynamic. Often, though I do not find it is frequently the case with Americans, the issue of corruption comes up. Americans tend to be shielded somewhat from the lively debate in India over corruption, the frequent headlines, lots of columns and ink spilled on that question. Labor laws will trouble you as well, the difficulty of hiring and firing. Notably for American businessmen, we find it complicated to get past some of the ownership cap issues. Indian official policy limits our ability to own majority positions in insurance, banking, to get into the media markets, to enter retailing, to enter the pension markets, all the latter two where fresh legislation is required before any entry is possible. India still today remains a land of high tariffs, though tariff levels have come down quite sharply over recent years. Among major Asian nations in the international market, India's tariff levels remain still quite high, in the mid-teens. They will come down, but one would also like to see a dynamic Indian external trading policy that would put India in the front ranks of those negotiating for a successful Doha round where international trade will expand in the years ahead. And for an American investor, watch carefully, because the tax authorities are really tough in India, occasionally whimsical, quite unpredictable, and dialogues between the taxman and a businessman are notably absent. There's much to be done. I won't make light of it, and yet I assert the controlling view, my controlling view, that India is on the move, will not be stopped, and will be a great world economic power, matching the top 3 or 4 over the next 10 years. The third factor I would leave with you is the state of our relations as Americans with India. Highlighted on July 18, it really comes as a remarkable turnaround in history. For most of the near 60 years of India's independence, the United States and India have been at odds with one another. India finding herself in the shadow of the erstwhile Soviet Union, the United States committed on the other side, and it wasn't until, as you pointed out, the Gulf crisis, that we had to begin to look at each other. For the Gulf crisis brought India to the table. The fall of the Berlin Wall brought the United States to the table. And we began a slow, painful rediscovery of one another and the definition of a strategic logic that would tie the United States and India together. Moves began in the time of President Clinton, when P.V. Narasimha Rao was Prime Minister of India. They accelerated, checked by nuclear tests in 1998, begun again when Clinton visited India, but picked up most strongly by the present administration and carried to the state that they stand at today. The Indian-American relationship is increasingly broad-based. When I was in India in the 1990s, one figured the relationship would be pulled by the economics of India's emergence. Today, it's not just economics. We have a vibrant security and defense relationship with India, a close identity of views in the war on terror, increasing possibilities of defense trade, interoperability, training between our military forces, and strategic intelligence exchanges. What lies at the heart of the Indian-American change is a sense that both nations need the other if the balance of power in this complicated post-Cold War world is to be maintained. In short, if peace and the conditions of prosperity are to be maintained, many important nations have to play their role, and India, with increasing self-confidence, is emerging in precisely that role. The joint statement that the President and Manmohan Singh issued on the 18th testifies to the common perspectives of two nations bound by both common values and belief in democracy and common interests, their views of the world and what will be good for our respective citizens. The joint statement goes on with a path-breaking set of decisions to accept, in essence, India's nuclear capability and endow the relationship with civil nuclear trade and the benefits of a collaborative arrangement. I believe that step will be A, the most contested, and B, the most important. And I only ask that all of you who follow the narrower debate over India's nuclear future and its relations with the United States, the whole question of non-proliferation on a world scale, remember that what I believe has really been accomplished in Washington this week is the setting of a stage in which we in India can work together. Before this week, we were at definite nuclear odds. After this week, there can be common perspectives, whether it's about Iran and North Korea, or whether it's about fissile material bans. Until this week, we had no diplomatic space. Now we have that. So where next? I won't argue that our two nations will always see eye to eye. We share such different perspectives on the world, it would be unwise to do so. We will see South Asia, which today stands at an uncommon period of normalization and détente in its history. Normalization or détente between India and Pakistan, those crises are deep-rooted and show possibilities of returning. I'd like to think as well that we're going to have to keep a very careful eye on how both of us view China and how we manage our relationships with that extraordinarily important nation. And India and the United States will, despite even the words of a great joint statement, not see eye to eye on what's the best way to organize the United Nations, including its Security Council. So there's much to be done. But I am not only an optimist about the work that lies before all of you in the business community, but what is the common purposes of two nations that need each other in a very unstable world.
Thank you very much. Ambassador, before we hand over, I just wonder, could you go back to that period in the 1994-1995 period and maybe talk a little bit about your interactions, if you would, with Manmohan Singh then, and maybe talk about the economic priorities that they were setting and where you see they've done well, what they have left to do, just in brief to give people a perspective of the man.
Well, I did have the pleasure of dealing with Manmohan Singh. The first and most important point that I discovered then and persists today is that Manmohan Singh is an intellectual, a man of profound decency, terrific, powerful honesty. He cannot countenance corruption. He is a man of deep intellectual attainments and a superb economic policy analyst. That said, and without being in any way disrespectful, he does not have a political bone in his body. It was necessary in the mid-1990s that Rao create the political context within which Manmohan Singh could work economic policy change. The anomaly today is that the present regime that Manmohan Singh has the prime ministerial responsibilities no longer has a unified political and administrative responsibility. You have on the one hand the party head, Mrs. Gandhi, a very close run in numbers in Parliament coalition with highly contradictory elements in it, the left front parties notably. And on the other you have the government. The Prime Minister in India today, Manmohan Singh, perhaps I could even argue doesn't have the will, but he certainly doesn't have the political whip to enforce the discipline of state policy on recalcitrant parties to his present coalition. And the division of authority between politics and administrative management is one of the reasons you're having so little traction today on a number of critically important economic issues that by the Prime Minister's own mind and imagination would lead him to want to take. He would want a greater degree of privatization. He would want to see the retail sector open to foreign investment. He would want to see the Electricity Act of 2003 implemented strongly throughout the country. He would understand, but he can't at the same time deliver. And we are walking into a period in about 18 months of fresh state elections where the closer you get to elections, just as in the United States, the less scope there is for economic policy entrepreneurship.
Thank you. Okay. Ashish, would you like to talk about your private equity perspective?
Sure. Thanks very much. It's a pleasure being here. I thought what I'd do is highlight sort of 5 points with regards to the historical context and the opportunities, and then talk about the risks and then the outlook thereafter. Ambassador Wisner talked about the historical growth of India and the fact that things have changed. If you look at the data, India grew at 1% between 1900 and 1950, grew at 3.5% between 1950 and 1980, and then grew 6% between 1980 and 2004. In the last 2 years, it had grown at an average of about 7.5%. So there's been a clear acceleration of growth over this past 100 years in India's economic life. More importantly, if you look at net population growth, that has consistently come down. So when you compute GDP per capita, the rate of growth of GDP per capita in the era when India was growing at 3.5%, which is between 1950 and 1980, was actually 1%, because net population growth was 2.5%. At 1%, you double GDP per capita every 54 years. Today, growth is 7.5%. Net population growth is closer to 1.5%. We're growing GDP per capita at 6%. That means you double GDP per capita in every 12 years as opposed to every 54 years. So there's a staggering change in terms of improvement in the economic lives of individuals in India, and I want to highlight that. Second point is that whilst there have been a number of changes at the macro level, which started in 1991, I believe that it often takes a decade for changes at the macro to filter down into the microeconomy. And let me give you a picture of India over that decade to give you a sense of how that change took place. And I'll point out one individual and one company in particular. The individual's name is Rahul Bajaj, and he runs a company called Bajaj Auto, which was the largest manufacturer of two-wheelers, and today is the second largest manufacturer of two-wheelers in India. When India flung its doors open in 1991, the reaction of the industrialists, and in particular Rahul Bajaj, was to form something called the Bombay Club. The Bombay Club was a group of industrialists, basically who wanted to protect their vested interests, and so their job was to convince the government to prevent tariff barriers from coming down, prevent foreign investment from coming in, because they were worried that their companies were going to get washed away. And effectively, from 1991 to 1996, it was sort of that Bombay Club era when it was really fighting against, reform. I think eventually businessmen realized, and Rahul Bajaj in particular, that the world had changed, globalization had set in, India was part of the world, we couldn't be isolated from the world. And so we had the next phase from sort of through the mid-90s and the late 90s, when Indian businesses sort of hunkered down and became more efficient, because they realized that the government was giving them time by phasing in reforms. The trade barriers weren't coming down immediately. We didn't have shock therapy the way Eastern Europe did. And so they had maybe 5 or 6 years, but they didn't have 20 years to change. And in that period of time, Bajaj Auto doubled its production, but cut its workforce in half. I.e., productivity of workforce went up 4x over a period of 6 or 7 years. Today, Rahul Bajaj is a proponent of India integrating into the rest of the world. He actually goes around talking about WTO and advising the government and, et cetera, et cetera. And what's happened over that 10-year period of time, effectively, is as Indian businesses have become competitive and they can stand up to companies from outside India, there's been a sea change in terms of entrepreneurial behavior in India. And there are three. I go visit a lot of companies as a private equity guy, and there are three changes in particular in the mindset of the entrepreneur. The first is the aspiration levels are totally different. When we went and visited companies 6 years ago, people were talking about taking a business from 100 million to maybe 150, 200 million. Today, people have learned how to dream big. And I think they've been inspired by companies like Infosys and Wipro and a number of other Indian success stories that have done better than anybody imagined. The second facet of change in the entrepreneurial mindset is global outlook. When I go visit a company that does $100 million of revenue in any industry, they can tell you what's going on in their industry in any part of the world. They're benchmarking themselves against European companies, against American companies. They've been to China. They've visited their competition. There is a clear awareness of what's going on around the world, and the benchmark is no longer the company next door, but it's a global benchmark. It's the Chinese who are being benchmarked against. So there's a global mindset that the entrepreneur has. And the third very important facet is that somewhere along the way, I think people realize that corporate governance pays, that it pays to be honest in business. And the way I would describe it is that, the Indian entrepreneur figured out that 15 times earnings is better than 1 time stealing. It's much better to create wealth through market cap as opposed to dividend stripping and taking assets out of your company at the expense of minority shareholders. And again, companies like Infosys and HDFC, ICICI have led the way in terms of inspiring younger companies in that direction. So the reason I agree with Ambassador Wisner is a lot of this is irreversible is because the changes at the macro level have now filtered down into the microeconomy. And behavior has changed. Entrepreneurial behavior has changed. They don't want to go back to the old ways. Consumer behavior has changed. Look at consumers and what they experienced, 15 years ago. I grew up in India. I remember it used to take 3 months, often a year, to get a phone line. You had to bribe somebody to get a phone line. Today there are 10 telephone companies that offer you phone service. There were 3 cars available at that point in time, all of which were circa 1960 models that were being offered to us in the late 80s. Today we can buy one of 50 different types of cars. All the manufacturers are there. So consumer choice is now available. I don't think the consumer ever wants to go back to the era of scarcity, where resources were scarce, where there was very few choices available. So for those reasons, it is very hard for politicians now to go back on the path that they have taken India down. Third point is that as an investor, I think one of the advantages of India is that we have a fairly deep and broad market. And I believe one of the interesting advantages for an investor is that India systematically does well in industries with high return on capital employed. Think about the industries where India does well. India does well in IT services, very little capital required in that business. ROC for Infosys and Wipro and these companies, even today, if you strip out the cash, is well north of 50%, actually it's close to 100% in the IT services business. Because it's not a capital-intensive business. It's a labor-intensive business. So wonderful return on capital business. So whilst these businesses grow, they don't consume capital, they spit out cash. Same is true of business process outsourcing. The same is true of pharmaceuticals, very high ROC business. Same is true of banking, a pretty good ROE business. So these are great businesses for investors because you get growth, because growth in these businesses translates into return for the investor. I think the problem with, whilst China does very well in mass manufacturing, the problem with mass manufacturing from an investor's standpoint is margins are terrible, barriers to entry are low, return on capital is poor, so growth doesn't translate into returns for investors. So I think there's a systematic bias in India towards being competitive in areas where return on capital is actually pretty good. And that works well for investors like ourselves. The fourth point, I want to just talk about the private equity market in particular. I think there's been a sea change in terms of the acceptance of private equity as an asset class in India. It's an asset class that got created essentially in the early 90s when 3 or 4 players came in. ICICI, a local bank, had already been there for some period of time, but Citigroup entered that market, and so did CDC, the British government. And in the late 90s, a number of other players entered, folks like ourselves. And what we've seen is that, particularly in the last 5-6 years, because we are a derivative product on what's going on in the economy. If the entrepreneurial behavior hadn't changed, we wouldn't be able to do a lot. we wouldn't be able to partner with these guys and be effective in their companies. And so what we've seen is an explosion in private equity, and off of a very small base, and still very small numbers today. This market was a $500 million market in terms of equity invested 3 years ago. Last year, $1.3 billion was invested, and this year, somewhere between $1.75 to $2 billion will be invested by a variety of private equity players. The market has three segments. There's the high end, which is 50-plus million equity check, 50 up to 200-300 million, where Warburg Pincus has been the largest investor in India. They've invested about $1 billion over the last 7 or 8 years. And now there are several new entrants like Blackstone, Carlyle, Temasek from Singapore, Newbridge, which is an arm or affiliate of Texas Pacific Group. And then in India, there's the mid-market, which is sort of 10 to 50 million in equity check, where there are 4 players who have the lion's share of that market today, although there are several new entrants. And there's Citigroup, Actis CDC, ICICI, and ourselves. And we all have been investing at the rate of about $100 to $150 million per year in terms of equity invested. And then there's more of the venture market, $3 to $15 million equity checks, Westbridge Capital, Jump Startup, GW Capital, Bearings India, etc. So we have a market today that's fairly vibrant. The reason I say all of this is because 5 years ago, everybody was doing everything. Very few firms had a strategy. Very few firms had a focus. I think today we've got a large enough market where there are several players who can focus on a particular, either on a set of industries or in a space in terms of whether it's growth capital or venture or buyouts. The market's gotten segmented. The players, their capabilities have gotten raised because they've started sharpening their skills in the area that they focus on. And whilst there's a lot of new capital coming in, Blackstones, Carlyles, etc., wanting to put lots of money in, I think that largely has an impact on the high end of the market, i.e. the larger deals will get priced at higher levels. Valuations will get driven up because there are very few of them, and several global players and Pan-Asian folks want to be in India, and they all get forced to playing in the large space because of their fund sizes. So that's a little bit about private equity. I was asked to talk about the risks, so I want to spend more time sort of highlighting some of the risks, because there are plenty. First is, as Ambassador Wisner alluded to it, very high fiscal deficit. India runs a fiscal deficit about 9.5% of GDP. Debt to GDP is at 83%. It was at 58% 5 or 6 years ago, so it's climbing. And the reason we haven't felt the impact of higher debt to GDP is because whilst debt to GDP has been rising, interest costs have been declining. So we've continuously refinanced India has fairly long-dated borrowings. We've continuously refinanced our paper at lower interest rates. And so in terms of absolute interest costs, it hasn't gone up in line with the absolute debt. I think that will persist for the next 3 or 4 or 5 years because interest rates, we continue to refi old paper, old government debt at lower rates, and debt to GDP will continue to rise, and at some point, because the fiscal deficit problem is not being fixed, is going to hit 100% debt to GDP ratio. At some point in time, that will turn, i.e. if rates kick back up, then you have a double whammy, which is debt is increasing and interest rates are increasing. So I think so far, India has been fortunate in that whilst we're headed into a debt trap, it's not visible. And I think the politicians will need to muster up significant political will to be able to push through change to reduce that fiscal deficit. The only mitigant to the fact that deficits are high and debt to GDP is spiraling upward is that it's all a local problem. Savings as a percent of GDP is 26%. So unlike Latin America, which blows up every once in a while because they're forced to raise money outside, the saving rates are low. In India's case, it's all largely an internal problem. The only foreign debt we have is long-dated multilateral debt. And so we're not subject to the vagaries of the marketplace or the outside marketplace. But nevertheless, it's a problem. The second issue is, valuation, if you look at valuations in India today, they've gone up dramatically. Whilst the overall market still trades at 15 times earnings, I think one has to actually piece through, what is that? Because that's a composite. And that composite is composed of commodity stocks. Do commodity stocks deserve to trade at 15 times peak earnings? Cyclicals. Do cyclicals deserve to trade at 15 times near peak earnings? Do financials deserve to trade at 15 times earnings? These are questions I ask myself. So, whilst the overall market is not way overvalued, my sense is it's somewhat overvalued, and really you have to boil down to looking at it sort of sector by sector to see where the overvaluation is the highest. I think the bigger problem is I don't think the biggest problem is valuation. I think the biggest issue actually is exuberance. And by that I mean that people are ignoring the risks that exist in the companies that they invest in. Small companies get the same multiples that large companies get today, whereas that gap was fairly wide 4 or 5 years ago. Bad promoters, and by promoters I mean entrepreneurs, owners, bad owners who had basically been blacklisted 4 or 5 years ago by the capital markets, couldn't raise a dime of capital. They were clearly individuals who had defrauded the banks. They're people who hadn't professionalized their companies. Today they're back in the market, raising capital. Their companies trade at valuations very similar to well-run companies. So I think what's happening today is just because there's capital rushing in, and often folks who have come to India for the first time, there's a lot of what I call story-based investing going on. Somebody sits there, runs you through a PowerPoint, tells you a story, the investor goes away and throws capital to work into that company without getting a sense of what really is this individual all about, what does the governance really look like, what are the risks. I think some of those risks are being ignored in this environment, and that's a global phenomenon. I think it's in emerging markets in general, there is a lot of exuberance. That doesn't mean to say that if you have a discerning eye, you can't find companies that are well run, that have good governance, and that trade at reasonable valuations. We believe you can, but one needs to be careful in this environment. The other risk, I think from a macro standpoint, is India's infrastructure. We have very poor infrastructure. India spends about $35 billion in infrastructure per year. To put it in context, China spends $260 billion per year on infrastructure. We spend a very small percent of GDP on infrastructure. There are some areas of the infrastructure that have improved. Telecom, tele-density has gone up 5 or 6-fold in the last 6 or 7 years. And with the cellular explosion, I don't think we need to worry about the telecom sector. I think it'll take care of itself. It's in private hands largely. Other areas like ports, there's been some improvement in India. And the ports are getting modernized. Container terminals are being put into the hands of foreign operators, etc. Roads, there's a national highway system being built. Whilst it may take a year or two longer, by the end of this decade, we'll have a fairly robust national highway system across India. The bigger issues, in my mind, on the infrastructure front are power, which is where the whole center-state issue comes in, which Ambassador Wisner was alluding to, and the area of urban infrastructure. Unlike China, we can't fix our urban problems by shunting people out and forcing them to move and stuff like that. And for those of you who visited Bombay, I'm sure it's fairly visible that we have urban infrastructure issues. So I think those are some of the major risks. I think the political risk, as an investor, I worry less about it today. I mean, I agree that India doesn't have the political will to push through bold changes, but at the same time, the politicians aren't doing anything stupid to reverse change. And as an investor, often the fact that whilst Ambassador Wisner doesn't like it, that the door doesn't get opened up to foreign investment fast enough, sometimes it's an advantage as an investor. I think the fact that foreign banks can't buy local banks right away means that as an investor, and a foreign investor as well, you can get into these banks before the door opens up in 2009. And so as an investor, it's often an advantage that foreign direct investment doesn't come in too quickly. Because if the door opens slowly, you can actually get in there before these companies get sold. I'm also less worried about the political risk because I think whilst we're not going ahead and fixing certain major problems, I think as far as investors are concerned, the economic agenda of the two political parties is fairly similar. If I showed you the economic agenda of the BJP and the Congress, it's not that different. So whilst people worry that, and last year a lot of folks were worried that the Congress had come into power, what was going to happen, I don't think we need to worry about that issue very much. I mean, since 1991, I forget, we probably had 7 or 8 different prime ministers. Not a lot has changed in terms of economic policy. The rate of change may have been faster in terms of bold steps under one regime versus the other. But there's been no reversal when there's been political change. So I worry less about political change, whereas the public markets sometimes do worry about that phenomenon. So that's all I have about the risks. I want to point out a couple of things in terms of the outlook going forward. I'm very bullish on macroeconomic growth out of India over the next couple of decades. We talked about it earlier. Demographics clearly works in India's favor, and I think India's learned to handle the demographics and the increased population to put them to work. As Ambassador Wisner was saying, 54% of our population is under the age of 25. India has 1.1 billion people, labor force of 420 million people. Put in context, China has 1.3 billion people, has a labor force of 775 million people. Their population is 20% larger, their labor force is almost double India's. The reason is that China has a working age population. China went through a massive demographic shift in the last 20-25 years with the one-child policy. India is going to go through a massive demographic shift in the next 20 years because our net population growth has slowed down naturally, as I was saying earlier. So our population will go from 1.1 billion to about 1.5 billion in the next 2 decades, but our labor force will go from 420 million to about 750 million people. Our labor force will almost double in these coming 2 decades. So this is a very positive phenomenon. China went through the same shift in the last 2 decades. India is going to go through this demographic shift in the next 2 decades. The last point I'd want to leave you with is that I think the India story from an investor's standpoint, private equity investor, public equity investor, real estate investor, whatever you may have it, is a 20, 30-year story. And we've got to keep that in perspective. I think often people rush in and get too excited and want to make money very, very quickly. I think particularly in this environment where lots of areas are overheated, where the risks often get ignored, I would say investors ought to look at investing in India, but ought to be cautious as well. Because if you get washed out or if you get burnt in the first 2 or 3 years, I can assure you you're going to miss out on the 20-year story. Because for the next 10 years, you're not going to go visit India. You're going to be worried, you're going to be essentially jaded by the experience of the 2 or 3 years when you didn't make money. So I think it's important to have that 20-year perspective because money will be made over 20 years. And so it's important to be cautious in times of exuberance. It's important to get to know the market well. And even if you miss out opportunities, it doesn't matter because the opportunities are going to be there for 20, 30 years. Thank you very much.
Thank you very much. Before handing over to Samir, I'd just like to say I've probably seen 8 or 9 different India offerings, in the last few months, and I'd say the common denominator is maybe there's a local fund manager, but there's not a lot of experience. There's a lot of exuberance, as we've heard. I think with Samir, you'll see that there's a lot of seasoning for, from early 1990s until today. He's really focused on it. I'd say one of the things that's most alarming for me is that I have a number of friends who run hedge funds in town, and they're all coming back from their first trip to India, but coming back with a portfolio already invested. And I find it quite staggering that in the course of one visit you can have decided and invested. And contrasting that with a perspective that's longer, with a raft of awards for excellent performance, I think this approach might be more compelling. Anyway, with that as an introduction, Samir, you've been very patient.
Thank you very much, and thank you for the kind words. Basically, I was following Indian markets since 1993, and many times during this time I felt that one day India will be the largest emerging market in the world, but primarily because all other markets would have become developed by then. It's only in recent years that we can, on a top-down basis, somewhat justify India. During the early part of my life in Alliance in India, basically the debate was always between a top-down and a bottom-up view on India, and our view used to be bearish and overweight. Bearish because on a top-down basis you were not comfortable or happy with the progress of liberalization or what the government can do or should do, but there were good companies, which I'll explain a little later. But what has happened in recent years is that because of the cumulative reforms over the last 13, 14 years, today, in some sense, a new investor going there can find that, okay, maybe it took 14 years for what could have been done in 7 or 10 years or 5 years. But today, in many industries, the opening up of the industries, the state of the reforms, the state of various steps that have been taken, starting with how much should foreigners own, how much should domestic investors own, how that has slowly expanded. Somebody going today into that market can find that reforms have happened, although for people who were participating in that during that process felt that it was very slow. I think India one day should feature in Malcolm Gladwell's book, A Tipping Point, because I think what has happened is that a number of small things have been done and no big thing has been done. And that is why people like Ambassador Wisner are not satisfied, but Ashish and I are satisfied, because doing it slowly has meant that we have been able to participate in the movement of this reform, in the progress of opening up, and how we have been able to all participate in that. But the problem again with India on an overall basis is that on a top-down basis you can build any story you like. In the last few years, India has gained stature and confidence because of the success of our IT sector and the fact that India has an inexhaustible pool of talented or educated English-speaking graduates. But India also has 350 million illiterate adults who cannot sign their own name, because that is the definition of literacy in India. On one sense, you can say that India has 25% people living below the poverty line, but the same Indians own 10% of the world's gold reserves at 200 billion today's market or value. And if people believe that gold is going to be going up, then India will be the biggest beneficiary of that. Even looking at the demographics and the fact that India is sort of demographically an attractive market because of the higher pool of people in the working age vis-a-vis the retired age. In the next 5 years, supposedly 80 million people will be added to the 16 to 64 age group, vis-a-vis 0 in Europe and minus 3 million in Japan and about 20 million in US. But the question is, will we be able to generate 80 million jobs for this young pool of people joining the workforce? Because so far our employment generation track record has not been very good in India in the last 5, 7, 10 years. So the fact is that from a top-down basis, it will all be dependent on your views on what you want to focus on. But India's real story is the story of bottom-up. It is a story that basically in many industries and in many sectors, transformation has happened and is happening. And this transformation is easy to understand, easy to see, and easy to make money in. If we look at the progress of the bottom-up story, because the top-down, I also don't have a real view that is it good or not good. But on a bottom-up basis, if we see that from 1991 onwards, when liberalization started, there was obviously liberalization affecting different industries and different sectors. But even before 1991, there was a stock market in India. The stock market in India started in 1875, and there were many, many listed companies at that time, maybe 5,000-6,000 companies at that time or more. And these companies were operating in private sector arena where the role of the government was basically as an irritant. It was the role of saying that you cannot expand, you cannot get foreign technology, that you cannot maybe hire and fire, maybe you cannot merge, or if you want to expand capacity, you have to take license from us. But otherwise, these companies were all competing to the best of their ability in those sectors in 1991 and before. So when liberalization happened, it basically meant, for these groups of companies, it basically meant freedom to operate, freedom to restructure your costs, freedom to price, say, items like cement and steel and sometimes pharmaceutical at market prices. And all that process took the next 10 years for these companies to become bigger like Bajaj Auto or somebody else. But from an overall market point of view, nobody would have made money in these sectors if you had invested in all the companies. Because simultaneously when some companies emerged successful, there were many companies that basically went bankrupt because they could not handle the reduction in protection. They could not handle the fact that their competitor had grown bigger. They could not handle maybe the fact that newer companies from abroad came in, or maybe newer companies were created to take advantage of this liberalization. And therefore, all in all, we today have an efficient group of companies in those sectors. But you would have had to find a few companies in 91, 92, 93, the ones who ultimately were able to succeed. But it's not necessary that we would have clearly known that at that point of time, that who would be successful. Because Bajaj Auto, for example, which turned out to be a very good investment in 94, 95, he was on the top of my personal hate list because of what he used to say at that time. But there was another group of companies, or another half of the industry, which was basically previously all government controlled. And these sectors were sectors like banking and telecom, insurance and asset management, power and airlines and infrastructure. And in these sectors, the way India has handled its sort of opening up is by opening these sectors to the private sector without being able to privatize their own companies that were operating in these sectors before liberalization. What I mean is that let us say you want to open the telecom sector for private players. The typical or the not typical, but the optimal model should be that the government of India takes its existing telecom company, which is already in business, strategically sell it to somebody, give them 1 or 2 years of monopoly for them to sort of restructure this company in the way they want it, and then open it to the world. And therefore you've achieved privatization, but you've also achieved that your existing company gets some value and that it sort of remains competitive when it is opened up. Now, because of politics, India was never able to sell, other than I think one case, a company strategically to anybody. So what we get in India in the public sector companies is basically divestment of shares into the market. That means you can buy shares of that company when the government wants to raise money. And many people like that as a form and call it privatization, but it is not really privatization because there is no change in the management, incentives, even in their overall, wages, salaries, nothing. And basically government control remains, and these companies become technically private to the extent of 10%, 20%, 30%, but they're really not private. But this gives enormous opportunities for the private sector companies that enter these sectors. Because the private sector companies that enter these new sectors of telecom and banking and insurance and like asset management and many other sectors basically came in without paying any premium. Because the sector was opened up to anybody and everybody who comes in, and the existing 100% incumbent company or companies of the government have not been restructured. So the new companies come in, pay no premium, and over time kill the government company. And that is what has been done in sector after sector, and more or less in every sector, investors have made 50 times and 100 times, and we also made once or twice returns of that kind. But broadly, you could make 10, 20 times without any real effort, because that whole group of new companies that came in over the next 5 years, 10 years, basically ended up cumulatively together owning 60-80% of that industry, and the government entity in the end, in some, that transition has not happened, but in some sectors it became 20% government stake, in some 50%. In the case of media, it became 0% government, without the government company being sold to anybody, but just because the private guys took it over. And this growth is of a totally different level. This growth comes at 3 levels vis-a-vis the growth in that first group of companies where the growth came because of your own restructuring and then your own killing each other for costs, and beyond a point you have to rely on the overall market growth. And of course the market growth in India is high, so it's not that those companies which survived and which succeeded did badly, they also did well. But in some sense that is a sort of a regular steady growth, instead of 5%, they started enjoying a 6% GDP growth, and maybe there was some change in consumer aspirations, so somebody grew faster. But in these sectors which were previously controlled by the government, the growth has been higher because A, the overall pie is expanding like in the rest of the economy, but secondly, the private sector companies grew at the expense of the government, and thirdly, because most probably the sectors in which the government was there before were the sectors where there was more under-penetration, fewer products, fewer services, because that was the very nature. Now, the good thing about India purely from a stock market point of view, is that this whole process has happened very slowly. Now, top-down investors or top-down strategists will say, why has India done this slowly? But that has been the best thing from a stock market point of view, that not all sectors were opened together. Not in all sectors has this transition of share from government to private already happened. There are many sectors where there is a government or many government companies, and there are private and many private companies, but still the government owns 80-90% of that industry in terms of output. And we feel that is a huge opportunity. It will go on for at least another 10 years, because sectors have been opened not only all in 91, some have been opened last year, some have been 3 years ago, 5 years ago. So the biggest mantra for us in terms of investing in India is to compete with the government of India. Now, this is completely different from the Chinese model, and that is why I think that nobody makes money in China, is because in China you basically buy that company, which is the government company, which again, like India, has not really been totally strategically sold. All these American companies, by wanting to signal, I don't know what to whom, put 2 billion, 5 billion, 10 billion to buy 2%, 5% stakes. And over time, in theory, if China is really opening up, then that company is the incumbent company. And there will be many 50 banks theoretically one day there, and those 50 banks will be starting with a 0 market share, and this government company or bank will be starting with 100% market share. So by definition, the newer guys in that country would be expanding or growing at a faster pace, and in theory, you would not be paying any premium for it. So in India, actually, the liberalization is better, although it is not seen, because you have allowed private sector into sectors voluntarily without asking for a premium from the government company. In China, you have delayed it, because till that government company gets a premium, till that government company finds a Bank of America, they don't really open it to the rest of the world. They delay the opening up of the market till their own investment, which is an old investment, realizes value. And that is why in India you are able to make money. Another reason why you're able to make money in India is because of foreign restriction. It is very good that insurance companies and telecom companies and power companies do not get 100% foreign ownership, because we want to participate in the stock market. If it was all 100% foreign owned, then somebody will make money. But we are talking about us here. In terms of the risks, but there has been progress. The thing is that there has been steady progress, and every month we can give you that what has been the new sort of liberalization that has happened. So cumulatively it is going on every day. Even in the new government, there have been many, many things that have been done, including a 12 billion FDI agreement with POSCO, which is by a factor of 5 the highest FDI agreement that anybody has done. That is a foreign direct investment agreement. There has been I think a good treaty done, or whatever, an economic cooperation treaty done with Singapore. There have been many things that are done individually, separately. They don't look big on any one, if you look at them alone, but cumulatively they are very good. Or at least they keep adding to the progress and reforms in the country. In terms of risks, well, the biggest risk in India
Samir,
is...
we just 1 minute warning, I guess, because I'd like to have time for questions.
Okay. Well, the biggest risk in India is that you don't know what is the next risk. So in the last 10 years, let me tell you what were the risks we faced while I was managing money there. In 1994, we had a plague. In 1995, when Manmohan Singh was the finance minister, he raised interest rates by, I think, 500 to 600 basis points, and the market fell 35% in 1 year. From 96 to 98, there were 3 governments, and one government lasted 14 days. In 98, India exploded a nuclear test or whatever they did, and there were US sanctions put on India. In 1999, we had a war with Pakistan and Kargil. And in 2000, of course, everybody corrected because of the markets corrected because of the normal correction in the world, or abnormal correction. In 2001, there was a stock market scandal related to the fact that in 2000, many people lost a lot of money. And I think it was in 2002 or maybe 2003, India had its worst drought since independence. So this was all the risks which you could not have imagined before, or maybe 1 or 2 you could have. But broadly, the risks in India are quite a few, but the opportunities, I think, outweigh that. Thank you.
Super. Thank you very much. Questions?
Question to the panel. highlighted the fact that India is going from 1.1 billion to 1.5, 400 million to 700 million population base, and the fact that the banks have been boxed out. It strikes me that one of the opportune areas is consumer credit and mortgages. Could you explain a little bit about the infrastructure of India and the banking side and the consumer credit and mortgage area? If there's any peculiarities or restrictions, and what opportunities?
Well, India's quite an overbanked economy in general. India has, I think, about 30 or more public sector banks. It has about 10 to 15 private sector banks, and nearly all foreign banks. The problem has been for the foreign banks is that they have not been allowed to increase branches beyond, I think, 12 to 15 per year. But beyond 2009, I think all foreign banks will be allowed to act in India as if they were local banks. But in general, the banking sector, banking services, mortgage market, retail credit market is all developed, although growing at a fast pace. One of our biggest companies in India is HDFC, which is in the personal mortgage market, and it's owns more than 70% by foreign investors. We have many foreign banks which have, private banks, which means Indian-owned private banks, where foreign ownership is not allowed beyond 5% today, and in 2009 again, all these restrictions will be removed. So the roadmap for banking is till 2009, and we like the private sector banks. But in general, the story is known and is there, and products are out there already.
Yeah, I think on the consumer credit side, penetration is still low, and so we're seeing a lot of growth. The mortgage market is still growing at about 25% year on year, and it's still a small market. It's about a $25 billion total market, and it's fairly short duration because in India people tend to repay their loans much faster because the penetration, we haven't penetrated down to the level of, we're still at, in urban India, these are salaried employees, they take the mortgage, but then they want to pay it back very quickly, often in 4 or 5 years. So it ends up being a shorter duration asset than these companies expect. And so on an annual basis, about $10 billion of mortgages added every year. But I think, as Samir was saying, the market knows that. Look at HDFC's stock. It's reflected in that already.
Sue, you have a question?
Yeah, Ashish, what are the most commonly used exit vehicles for private equity?
I think for private equity, as I said earlier, I think the bulk of the market in private equity is still growth capital market. So I would say 85% of the deals are growth capital deals. India is not a buyout market. I don't see it being a major buyout market for at least another 5 to 10 years. And the reason is we're not a developed economy. The entrepreneurs haven't hit age 65 or 70. We don't have a lot of conglomerates that are looking to divest. The debt markets are becoming more vibrant, but they're still not there in terms of cash flow lending, etc. So given that we don't have a buyout market, and most of it is growth capital, perforce growth capital investing means you are a minority investor in these companies. So a fairly high proportion of the exits have been through the public markets. And then secondly, there have been some trade sales as well, particularly in earlier stage deals. So we've done some early stage deals where we've actually had control, where we've sold these businesses. But M&A volume in India is still quite low. And so often what you're doing is, building up these companies that have maybe 50, 100 million of revenue, getting them to the right stage, taking them public, and then thereafter getting out. Or what often happens in India, because there's so many listed companies, is there have been a lot of pipes as well, investments into public companies, where it's below the institutional radar, smaller companies, you own 15-odd%, build the company up, get it onto the institutional radar 3-5 years later, and then exit thereafter.
I have a question for Ambassador Wisner. You've met many corporations and senior executives coming to India who've done strategic planning and are looking at the economy. You must have a very distinct sense for what the American appetite is for different areas. Could you either confirm or elaborate on some of those?
Let me make sure I understand. Confirm or elaborate on the areas.
Well, confirm what we've heard from Ashish and Samir in terms of what they're saying, or are there sectors that people are very focused on that have not been discussed?
No, I couldn't take exception with either set of remarks. They're spot on. I think there's some terrific opportunities. I was just thinking when Ashish was addressing how you find exits in India, while in general I think that's right, there may be some notable exceptions. For example, I can see at the moment a consolidation of the telecommunications markets, which will be very big ticket items for American investors to come in and assist in that consolidation. The present structure of the Indian industry growing as rapidly as it has it's an open candidate for serious restructuring. But I think generally what I've heard is right. From my own experience, in terms of the previous question the gentleman asked, I'd like to underscore something that Ashish said, and that is how, as mature as the concepts are, as available and present are Indians with skills in those sectors, questions like asset management, consumer finance, mortgage finance are still in their infancy. Correct. In my own company's case, in AIG, indeed, we'd like to own 49% of our company. We'd be happy to see the other 51% on the public market.
Okay, we're happy with that.
But I think we are going to go ourselves into consumer finance next year. We're right now putting together an asset management company. We're doing it on a greenfield basis in both cases, as opposed to trying to buy out rather highly valued existing Indian enterprises, look for the human resource potential to do that. So I think these are markets, this is, in general terms, a market with just terrific growth potential, but you've got to be a sensible investor, be able to be patient, take the time it will take to build a proper investment, play for the long term.
Thank you. I think we've got time for one more.
Well, I'll ask a question I've asked at other emerging market panels. They've shown a very strong correlation, research has shown a very strong correlation between property rights and per capita GDP. So I'm interested in understanding the status of property rights and its enforcement in India.
You want me to start?
We'll go to answer this one.
Yeah. I feel really genuinely, I'm going to let my two colleagues be more careful. I have felt that in property rights, depends what kind, I don't today worry about the nightmares of my youth in the 1960s when governments took over private property. That's behind us. But India does have the normal menu of people disputing property, either real property or industrial properties. But the Indian system is notable, in my view, with the quality of its judicial system. Now, I admit that the Indian judiciary takes a very long time in making decisions. The case burdens the courts face are absolutely overwhelming. But the lawyers are skillful and the judges are smart. And in property issues that I've seen American companies involved in, if it's an important case, the judiciary is even more flexible than the American system to move an important case up on the docket and get a quick decision. I also am highly heartened by the steps being taken, often in consultation with our own judiciary, starting with the Supreme Court that's in very close touch with the Indian system, to speed up, modernize, introduce new techniques into the whole judicial system, and introduce what I think will be very promising is dispute resolution mechanisms that are independent of the court systems. So I'd like to think that property rights protections have a strong legal underpinning in India, and this is a real attribute to those who are considering investments.
I think there have not been very many cases where this has been an issue. But in the rental market, for example, in Bombay, there was an issue whether the apartments are owned by the guy who's rented the apartment, but that is true even, I guess, somewhere in New York, or the Rent Control Act and that. But in general, there are no issues like that, whether property as in physical property or property as in ownership of any asset.
Thank you very much, Samir, Ashish, Ambassador Wisner. Thank you for your comments, and Ambassador Wisner, thank you for your service. I'm now going to hand over to Steve McMenamin for closing remarks.
I thought it was the laundry list. Susan reminds me that if you would, as a courtesy to our speakers, if you would fill out the backside of the invitation card so that we can give them some of our feedback. Secondly, I also want to apologize to everyone. Some of you may have received telephone calls or emails disinviting some of your colleagues. We apologize for that. We just have too small of a room. The good news is we're building a new museum. The bad news is we have to move the dog pound first before we do that. So it's coming. And if you would, remind your colleagues when you come, those of you who are members of record, that the inner ring is reserved for the members and that your guests should sit in the other seats. I do apologize for those of you who may have been disinvited. August 18th, Jon Snow has canceled on us, so for the first time in 4 years, we get August off. There will be no roundtable next month. Fourth, Best Practices has been released. It's being circulated right now. We're getting a very good reception for it out in the marketplace. I want to thank Michael Castine and Spencer Bodges for helping us spread the word down in Washington. At the same time, we have lifted a 10-year ban on talking to the press. Ryan's point of view has been, we have a good thing here. Let's keep it to ourselves. Marilyn's point of view was, at the opposite end of the spectrum, there is very little or no risk for us to disseminate this in the investor community, so let's do it. And with that, we are. So you may be seeing me and some of our other members get quoted in the press, and you may see some articles to that respect. And by the way, spread the word. This is a very good session, and once again, a testament to the power of our Rolodex. And with that, again, I want to thank David and Reba Williams for introducing us to Karan Trehan. Karan, in turn, has introduced us to Samir and Ambassador Wisner. I also want to thank Peter Lawrence for introducing us to Ashish. And more importantly, we are not a hedge fund club here. The person sitting to my right probably has put together one of the best private equity portfolios and could be construed as a gold standard in the private equity marketplace, and that is Sue Carter and the Common Fund Institute, who is underwriting the session today. And with that, Sue, would you like to say anything to the members?
Sure. Thank you, Steve. It's my honor to be affiliated with the Greenwich Roundtable. It's really a terrific organization, and I've been to a number of programs which I think are really great. So thank you very much for our involvement. This panel was no exception. It was really terrific, and it's really interesting to us at Common Fund because 6 of us are going to India for the first time in November to study both the public and the private markets. So it's very timely from our standpoint. I'm actually sitting in for John Griswold, who heads up Common Fund Institute. And for those of you who don't know Common Fund, we're a nonprofit investment management company, and we were started with a grant from the Ford Foundation. When we were originally started back in 1971, a portion of that grant was earmarked for education and research, and that's done through Common Fund Institute, which is headed by John Griswold, who would be sitting here if he were available today, but unfortunately he's not. So thank you very much.
Thank you, Sue. And John is on sabbatical and enjoying himself, hopefully. This whole series has been very, very enlightening and instructive. Ryan has led this whole series, and with that, Ryan and I have been putting together these symposiums. Ryan, I'm always of the mind, like, let's get the panel set, and Ryan has always said, let's hold out for the best. It's like, for example, Latin America was a nightmare. It took us over a year to put that one together, and I do have to say, Ryan, it's worth the wait. So, Ryan, thank you very much. Ambassador Wisner, Ashish, Samir, thank you. Job well done.